In 2008, the United States government bailed out Wall Street with $700 billion in taxpayer funds. The man who designed that bailout was Henry Paulson, former CEO of Goldman Sachs. The man who implemented it was Robert Rubin's protege, Tim Geithner. Rubin, also former Goldman co-chairman. The banks that received the largest payouts? Goldman Sachs was among them. If you needed a referee for a boxing match, would you hire one of the fighters' former coach? This is the Gilded Archives, where history's ledgers reveal tomorrow's patterns. Today's topic isn't about corruption. It's about something far more elegant, a 150-year-old mechanism called regulatory capture. Goldman Sachs perfected it. In 1869, Marcus Goldman arrived in New York and opened a small commercial paper business. He bought promissory notes from jewelry merchants at a discount, then sold them to banks at face value. The spread was his profit, simple arbitrage, nothing revolutionary. His son-in-law, Samuel Sachs, joined in 1882. Goldman Sachs became a partnership. By 1906, they'd pioneered the initial public offering structure, taking United Cigar Manufacturers public. They'd discovered something profound. The real money wasn't in trading goods or even money. It was in structuring the deals that moved capital between entities. By 1929, Goldman Sachs Trading Corporation, their investment trust, had collapsed spectacularly, losing 92% of its value in the crash. The partners survived. Their clients didn't. The lesson learned: structure the vehicle so the architects profit regardless of outcome. They learned it early. Fast forward to 1970. Gus Levy ran Goldman Sachs. He had a problem every investment bank faced: regulation. The Glass-Steagall Act of 1933 had separated commercial banking from investment banking after the 1929 crash. Investment banks couldn't take deposits. Commercial banks couldn't underwrite securities. The walls were clear. Levy did something brilliant. He didn't fight the regulators. He befriended them. Former government officials were brought into Goldman as partners. Former Goldman partners were encouraged to pursue government roles. The revolving door wasn't invented by Goldman, but they industrialized it. This matters because between 1970 and 2024, this mechanism evolved from occasional appointment to systematic capture. The Treasury Department, the Federal Reserve, the SEC, the National Economic Council, all became staffed with Goldman alumni at crucial decision points. Not as a conspiracy, as career optimization. This is the mechanism John D. Rockefeller used with railroad regulators in 1870. This is what J.P. Morgan used with the Treasury in 1895. Goldman Sachs simply modernized it. They made it a talent pipeline that ran both directions. And here's why that matters right now. When the next financial crisis hits, the people writing the bailout will have spent their previous career at the banks receiving it. In 1980, Robert Rubin joined Goldman Sachs after working in law. By 1990, he was co-chairman. He had a problem. Glass-Steagall still existed. Investment banks like Goldman couldn't merge with commercial banks. They couldn't access depositor funds for proprietary trading. The profit ceiling was structural. In 1993, Rubin left Goldman to join the Clinton administration, first as head of the National Economic Council, then as Treasury Secretary in 1995. His mission, stated publicly, was to modernize American finance for global competition. What he actually did: dismantled the New Deal financial architecture piece by piece. In 1999, Rubin was the key architect behind the Graham-Leach-Bliley Act, which repealed Glass-Steagall. Investment banks and commercial banks could now merge. Depositor funds, insured by taxpayers through FDIC, could now be used for speculative trading. The walls came down. Rubin left Treasury in 1999. He immediately joined Citigroup as a senior counselor, earning $126 million over the next decade. Citigroup was one of the primary beneficiaries of Glass-Steagall repeal. It had lobbied for years to merge commercial and investment banking operations. The innovation here wasn't the policy change. The innovation was normalizing the idea that Goldman executives were uniquely qualified for Treasury roles, not because of corruption, but because of expertise. Who better to regulate Wall Street than someone who'd run it? The logic was seductive. The outcome was predictable. By 2024, Treasury Secretary as a job title implied former Wall Street executive, the way doctor implies medical school. Rubin made this career path not just acceptable, but expected. Henry Paulson joined Goldman Sachs in 1974. By 1999, he was CEO. He had a different problem. Goldman was still a partnership. Partners bore personal liability. In a crisis, they could lose everything. Goldman needed the liability protection of a corporation. In 1999, Goldman Sachs went public. Paulson oversaw the IPO. The partners cashed out. Personal risk evaporated. Now, if Goldman failed, shareholders bore the loss, not management. In 2006, Paulson left Goldman to become Treasury Secretary under George W. Bush. His Goldman stock was worth $700 million. Under government ethics rules, he had to sell. He sold it tax-free, a special exemption for incoming government officials. He saved approximately $100 million in capital gains taxes. Then 2008 arrived. Lehman Brothers collapsed. AIG was hours from insolvency. The entire financial system was freezing. Paulson, as Treasury Secretary, designed the response, the Troubled Asset Relief Program, TARP, $700 billion in taxpayer funds to bail out banks. Goldman Sachs received $10 billion directly. But here's the elegant part. AIG owed Goldman $13 billion in collateral for credit default swaps. If AIG collapsed, Goldman might not get paid. The government gave AIG $85 billion. AIG paid Goldman 100 cents on the dollar, full value, no haircut. Goldman's executives had structured derivatives to ensure they'd be first in line when the government rescued their counterparty. Paulson didn't create the crisis, but the man who designed the bailout had spent 32 years at the bank that benefited most from it. Every time you hear, too big to fail, you're engaging Paulson's framework from 2008. The innovation wasn't the bailout. Governments have always rescued banks. The innovation was making it bipartisan, inevitable, and legally unchallengeable. Paulson made systemic risk into a non-negotiable fact of life. Tim Geithner never worked for Goldman Sachs directly, but he was Robert Rubin's protege at Treasury in the 1990s. In 2003, he became president of the New York Federal Reserve, the Fed branch that directly regulates Wall Street's largest banks, including Goldman. When Obama won in 2008, Geithner became Treasury Secretary. His job was implementing and expanding Paulson's bailout framework. Geithner did something Paulson couldn't. He made the bailout permanent. The Dodd-Frank Act of 2010 was sold as financial reform, punishment for the banks that crashed the economy. Read the actual text. It codified systemically important financial institutions, SIFIs. Too big to fail became official policy. The largest banks, including Goldman, now had explicit government backing. Their borrowing costs dropped because creditors knew the government would rescue them. Smaller banks didn't get this designation. They had to compete against giants with implicit government guarantees. Geithner left Treasury in 2013. He joined Warburg Pincus, a private equity firm, as president and managing director. His reported compensation, $4 million in his first year. The Revolving Door spun again. The mechanism Rubin normalized, Paulson operationalized, Geithner institutionalized. By 2013, it wasn't even controversial anymore. It was how the system worked. But there's a fourth architect, and this one explains why the mechanism became permanent. Lloyd Blankfein became Goldman Sachs CEO in 2006, right as Paulson left for Treasury. During the 2008 crisis, Blankfein had direct access to Paulson and Geithner throughout the bailout negotiations. Goldman's interests were articulated in real time as policy was being written. In 2009, Blankfein told the Times of London that Goldman was doing God's work. The statement was mocked, but it revealed something crucial. Goldman's executives genuinely believed they were systemically important, that their survival was synonymous with financial stability. Under Blankfein, Goldman formalized the government relations operation. They hired more former officials. They placed more alumni in government. Between 2008 and 2016, at least 19 Goldman alumni held senior positions in the Obama administration alone. Gary Cohn, Goldman's president, became Trump's chief economic advisor and head of the National Economic Council in 2017, the exact role Rubin held under Clinton. Steve Mnuchin, who spent 17 years at Goldman, became Trump's Treasury Secretary in 2017. The mechanism worked regardless of which party held power. This is what makes it elegant. It's not corruption in the traditional sense, no briefcases of cash, no explicit quid pro quo. It's structural. Goldman hires the most ambitious people in finance. Those people make partner, accumulate wealth, and pursue public service. In government, they naturally advocate for policies they genuinely believe are correct, policies that happen to benefit the industry they came from and will likely return to. Then they leave government, and their experience regulating Wall Street makes them extraordinarily valuable to Wall Street. The mechanism is self-reinforcing. Now here's where it gets personal. You don't choose to engage the system, you already do. Every 401k, every pension fund, every index fund, they all flow through the infrastructure Goldman helped build. When the Federal Reserve conducts open market operations, Goldman is one of the primary dealers. When the Treasury issues bonds, Goldman underwrites them. When corporations need to go public, Goldman structures the deal. The firm sits at every major junction of American capital flow. You need to save for retirement. Well, your options flow through broker-dealers regulated by former Goldman executives. You want to buy a house? Mortgage-backed securities are traded on markets Goldman helped design. You think you're choosing between financial products. You're choosing which branch of the same tree to climb. Robert Rubin deregulated it. Henry Paulson bailed it out. Tim Geithner institutionalized it. Lloyd Blankfein normalized it. You inherited it. By 2024, Goldman Sachs had $1.59 trillion in total assets. They employed 45,000 people globally. Their alumni network included Treasury Secretaries, Fed governors, White House advisors, and central bank presidents across multiple countries. This isn't just an American phenomenon anymore. Goldman exported the model. Mario Draghi, who ran the European Central Bank during Europe's debt crisis, was formerly a Goldman vice chairman. Mark Carney, who ran the Bank of England, worked at Goldman for 13 years. The revolving door went global. The pattern here is older than Goldman. In 1895, J.P. Morgan bailed out the U.S. Treasury directly when the government ran out of gold. He dictated terms. The government accepted. Morgan became essential. In the 1970s, David Rockefeller, Chase Manhattan Bank chairman, had direct access to every president and Treasury Secretary. His bank's interests were considered synonymous with American interests. In 2008, Goldman Sachs achieved what Morgan and Rockefeller had. They became too essential to fail, too connected to be truly regulated. We're not approaching this pattern. We're living in it. The next financial crisis, and there will be one because the incentives guarantee it, will be managed by people whose previous job was at the banks being managed. The framework is permanent now. Dodd-Frank codified it. Central bank doctrine assumes it. Political appointees rotate through it. The mechanism has become infrastructure. So what does history say happens next? 3 paths emerge from every captured regulatory system. Path 1, accept it and use it. Recognize that the largest financial institutions have government backing. Position accordingly, they'll be rescued. Their shareholders might take losses, but the institutions survive. Goldman has survived every crisis since 1869 by being structurally positioned at the center of capital flows. That's a 155-year track record. The system delivers efficiency, consolidated markets, liquid capital, fast transactions. You get convenience. They get systematic advantage. Path 2, resist it. Move capital to smaller institutions, credit unions, community banks, regional firms. They don't have former Treasury secretaries on their board. They also don't have implicit government guarantees. They're more expensive, less convenient, more likely to fail in a real crisis. But you're not feeding the mechanism. The cost of resistance is real. Higher fees, lower returns, less access. The autonomy is also real. Path 3, position within it. The pattern says regulated monopolies extract value indefinitely until they collapse under their own weight. Standard Oil lasted 41 years. AT&T lasted 70 years. Goldman Sachs is 155 years old and still growing. Why? Because they're not resisting regulation. They're writing it. Pattern recognition here means understanding that captured systems don't collapse from external pressure. They collapse when the host economy can no longer support the extraction. We're not there yet. But there's a deeper protection beyond assets, capability. In every financial collapse we've examined in these archives, Weimar Germany, 1930s America, 1990s Russia, 2000s Argentina, the people who survived weren't the ones with the most paper wealth. They were the ones with skills that remained valuable regardless of which currency or system dominated. The lawyer who could navigate new regulations, the engineer who could maintain critical infrastructure, the farmer who controlled food production, the doctor who provided essential services. Production and essential expertise never lose value. Paper promises always do eventually. Goldman Sachs understands this. That's why they don't just trade financial assets. They trade access, expertise, and structural position. Let's return to the opening paradox. In 2008, the referee was one of the fighters' former coach. How did this happen? The world doesn't permit conflicts of interest out of incompetence. It permits them because the system was designed by the very people who benefit from the ambiguity. Robert Rubin didn't accidentally end up at Treasury and then Citigroup. The revolving door isn't a bug, it's the feature. It ensures that the people writing financial regulation have deep relationships with the entities being regulated. This benefits Goldman because their alumni shape policy. It benefits government because they get experienced professionals. It benefits the individuals because they get wealthy coming and going. The cost is externalized. When the system fails, taxpayers fund the bailout. When the system succeeds, Goldman partners collect the bonuses. The asymmetry is structural. History has seen this pattern before. In 1720, the South Sea Company collapsed. Its directors included members of Parliament. They'd written the laws that enabled their own speculation. In 1929, investment trusts collapsed. Their managers were also their regulators. In 2008, investment banks collapsed. Their former executives designed the rescue. Same pattern, different century, same outcome. The architects survive, the public pays. We've completed every stage of regulatory capture that history documents. Stage 1, industry hires talented people. Stage 2, talented people move to government. Stage 3, Government officials advocate for sensible regulation that industry can live with. Stage 4, officials return to industry, rewarded for their service. Stage 5, the cycle becomes normalized, expected, defended, as necessary expertise exchange. We finished Stage 5 in 2013 when Geithner's move to private equity barely made headlines. The pattern says this continues until the host economy can no longer sustain the extraction, at which point the system resets, usually through crisis, occasionally through reform. The mechanics of the next crisis are already visible. Derivatives exposure at the largest banks, including Goldman, is measured in hundreds of trillions of notional value. The balance sheets look stable until they don't. The rescue mechanism is already in place. The people who will write it are already in position, either in government now or waiting at firms like Goldman. The archives are clear on what comes next. Not prediction, pattern recognition. Every captured regulatory system eventually produces a crisis large enough that public tolerance breaks. Sometimes that takes decades. Sometimes it takes a century. We're 46 years into the modern Goldman Treasury pipeline that Gus Levy formalized in 1970. We're 25 years past Rubin's deregulation. We're 16 years past Paulson's bailout. The mechanism has decades of momentum. Betting against it in the short term means betting against 155 years of Goldman survival. Betting on it indefinitely means ignoring every historical precedent for how extracted systems eventually fail. The firm that Marcus Goldman founded in 1869 to trade commercial paper now sits at the center of global capital flows. They achieved this not through superior trading, though they trade well, but through superior positioning. They placed their people at every decision point that mattered. They made themselves essential. They turned the revolving door from an occasional scandal into standard operating procedure. They didn't break the rules, they wrote them. The Treasury Department isn't controlled by Goldman Sachs. But when financial crisis arrives, the Treasury Secretary's phone rings, and there's a very high probability the person answering has Goldman's number memorized from their previous career. That's not corruption. That's regulatory capture perfected over 55 years. It's what happens when the people regulating an industry are drawn from and returned to that industry. It's what J.P. Morgan pioneered, what David Rockefeller normalized, and what Goldman Sachs industrialized. The next Treasury Secretary is likely in their office right now, somewhere on Wall Street. They're managing capital, advising clients, structuring deals. In 5 or 10 years, they'll get the call. They'll sell their stock tax-free. They'll take the oath. And when the next crisis hits, and there will be one, because that's what highly leveraged, loosely regulated, implicitly guaranteed financial systems do, they'll write the response. The banks they used to work for will be first in line. The mechanism will work exactly as designed. If you think this analysis is wrong, explain where. If you think it's right, explain why it continues. Either way, the archives show the pattern. We're just showing you which page you're on. Subscribe to the Gilded Archives. The revolving door spins predictably. History already wrote the script. We're just reading it aloud.